to Fred Accounting Tutorial. Today we'll be dealing with the topic Consolidated Financial Statement. So we want to first know what consolidated or consolidation is. Consolidation is the process of combining financial data from departments or business entities within an organization. When we say to consolidate, or when a question says you are required to consolidate these accounts, it just means to join things together. Like we'll be dealing with two companies majorly, which are the parent and the subsidiary. So when they say we should consolidate the parent and the subsidiaries, it just means that we should bring the two accounts at the end of the financial period. Fine, at the beginning of the accounting year, the accounts will be prepared under a separate business entities, but at the end of the financial period, we'll be asked to consolidate. So, in the consolidated financial statements, there are four major types of accounts that can be consolidated, which are the four accounts that can be consolidated are the consolidated statement of financial position, consolidated income statement, the consolidated statement of cash flow, and the consolidated changes in equity. So we'll be starting with the consolidated statement of financial position. So the consolidated statement of financial position this account deals with organizations and not individuals. So we'll be in companies. A acquires shares in another company. So for example, let's say there are two companies, A and B. Let's say A acquires more than 50% shares. Let's say, for example, A acquires 55% shares in B Limited. Technically, A becomes the parent and B becomes a subsidiary to A. There are many complex or simple group structures. This is an example of a simple group structure where two companies are involved, where one is the parent and the other is the subsidiary to the parent. So in case of complex structures, let's say that means since A has acquired 55% shares of B Limited, B will be left with 45%. Let's say C acquired the remaining 45% of B Limited. C becomes a sub-subsidiary to A and B becomes a subsidiary to A. That is an example of a complex group structures. But in the example of questions that we are going to be solving, we are going to be dealing with simple group structures. So anywhere we come across consolidated statement of financial position, there are 4 or 5 things we have to do. The first one is the group structure. With this example I did earlier, where I said companies A acquired 55% shares in company B. So companies A technically becomes the parent, while companies B is left with 45% shares. So the 45% shares, if they should give us information that C bought it or they didn't give us information about it, so the 45% will be left for the NCI, which is the non-controlling interest, and the total will be the group, which is 100%. So the first one is we called the group structure. So now we now to move to second one, which is the goodwill on acquisition date. Goodwill is always done on acquisition date because the parent cannot calculate goodwill after he has acquired the company, because his input will have already been added to the goodwill. So the goodwill must be done on acquisition date. So as we solve multiple questions, about 5 or 6, we understand the difference between acquisition dates and reporting dates. But in a nutshell, acquisition date is just the date the parent bought the company, while reporting date is the date the account is coming out. So goodwill is calculated at purchase consideration minus the net asset of a company. For example, let's say the total net asset of the company is 10,000 naira. And technically, if I want to acquire a company, when they should tell me that the total net asset of the company is 10,000 naira, I should just pay the 10,000 naira and acquire the company. But as at the reporting date, when they are seeing the amount paid by the parent, whether for example you are seeing 12,000 naira, the extra 2,000 is not a mistake. The extra 2,000 is called the goodwill, because the parent is not just acquiring the company, it's also acquiring their loyal customers, their good name, and other things. So this 10,000 naira will be called the net asset. Okay, so the first question we are going to treat: P Limited bought 100% ordinary shares from S Limited on 1st November 2022. The individual statements of financial position as at that same day are as follows. We have the non-current assets, investments in S Limited, net current assets, ordinary share capital, retained earnings, and the last statement: you are required to prepare a consolidated statement of financial position for P Limited Group as at 1st November 2022. Now, I said something about the acquisition date and reporting date. So in this question, we're only given one date, which is 1st November 2022. So the day P Limited acquired ordinary share from S Limited, on that same day, that was when the accounts came outside. That means the acquisition date is also the reporting date. So we do not have any issue of identifying the acquisition date from the reporting date. So this question is straightforward. But when we are solving more complex questions, we try to identify reporting date and see how that one applies to. So the first thing we are going to solve here is our group structure. We have the 100% for parents and 0% for our non-controlling interest. So number 2, we have the goodwill on acquisition. Date. So I said goodwill is purchase consideration which is the purchase consideration is the investment in S Limited, 30,000, less our net assets. Please, let's understand the meaning of this net assets. Now, we all know our financial or accounting equation, which is asset equals to equity plus liability. Our accounting equation equals to asset equals to equity plus liability. But the name of accounting that came out, like when we are paying for our assets, we can not also be paying for our liability. So we have to net off our liability for us not to be paying for debts that when acquiring a company, we should not be paying for the debts that we do not know about. So it's just like saying this asset, when this liability cross the equation sign, turn to minus, equals to equity. So asset minus liability is called the net asset, equals to equity. When we say net asset equals to equity, so any figure that is in the net asset, because of this equation sign, is also the same figure that will be in the equity. So in most questions that I've solved, we will not be given net asset in the questions, but we'll be given equity. Definitely, if you are given equity, we can also use the figure for net assets. Am I making sense? We can also use the figure for net assets. So in this question, our equity value or our net asset value are the ordinary share capital and retained earnings. So our ordinary share capital and retained earnings, which is, because it's S limit, we are buying the S Limited, so we are picking the value from S Limited, 18,000 and 4,000, that is 22,000. So the difference is 8,000 naira. So our goodwill is 8,000 naira. Now we move to number 3, which is group retained earnings. Or income surplus. They have to on reporting date. In this question, we don't have issue for reporting and acquisition dates because the date of acquisition is also the day the account was reported. So is equal to income surplus plus post acquisition. The formula is income surplus. So our income surplus is our income surplus 250, 25,000, and our post acquisition profit. We're not given post acquisition profit. The only profits that was given was on the reporting dates, so we're not given any post acquisition profits. Profit on reporting date was 4,000 naira, so definitely no post acquisition profit, so 0. That means our group retained earnings remains 25,000. Now we go to number 3. which is, number 4, which is our non-controlling interest. Our non-controlling interest, NCI, because here our non-controlling interest is 0%, so definitely there will not be any value for non-controlling interest to be 0. So we have to prepare consolidated statement of financial position. So it will be consolidated. So our non-current assets, is 75,000. Now we have to just bring the two accounts together. As I said, consolidation just means bringing together of two accounts, two organization accounts together. 75,000 plus 20,000, which will give us 95,000. After that, we take our goodwill from workings 2, which is 8,000, and we also take our net current assets, that is 5,000 plus 2,000. So that will give us a total of 110,000. Here we are done. We now go to the equity. So the first value is our ordinary share capital. Our ordinary share capital is 85,000 and 18,000. But let's take note of this. Anytime we are calculating our goodwill, we have used the investment in S, which is 30,000, over our net assets, which is 18 and 4,000. Definitely the 18,000 and the 4,000 has cancelled our 30,000, giving us a difference of goodwill, which is 8,000 naira. So we are not using the 30,000 in our consolidated account. That's why we didn't use it. And we are not also using the 18,000 and the 4,000 in our consolidated statement of financial position. So we are in our ordinary share capital, we are only picking the 85,000 naira. Ordinary share capital 85. After that, we go to our workings 3, which is group retained earnings or income surplus. That will be workings 3. which is 25,000. That is all. So our balance will also give us 110. That is how to prepare a consolidated statement of financial position. So where the problem lies, the big four.